Hello, everybody. Welcome back to our Fireside Chat series. Today, we're proud to have David Lohman and Timothy Jacobs with Hunt and Andrews Kurth here to discuss the tax credit monetization under the Inflation Reduction Act, a very timely subject. But before we start, I'm Michelle Littlefield. Just a little bit about our hosting program. I'm a program coordinator with the United States Energy Association. We're a nonprofit, non-lobbying organization, and next year will be our 100th anniversary. We've done work in over 100 countries with programs like USAID, State Department, and of course, DOE, fossil energy and carbon management. DOE funds our specific program. We call this consensus for short. This is a cooperative with, our mission is to educate the public, policymakers, industry stakeholders, anyone who's interested in CCUS and carbon management as a whole. We do this with hosting public webinars such as these, a series of monthly educational briefings. We also do conference workshops. We release technical reports and bi-monthly news clips of CCUS and carbon management related subjects. This can include rare earth elements, critical minerals, blue hydrogen, environmental justice as it relates to carbon management, and tribal energy articles to our interested audience. If you would like to subscribe, please feel free to email me at the address at the bottom of your screen. So at the end of everyone's speeches, we'll do a Q&A portion. Please use the Q&A button during the presentation or afterwards to ask your questions. This will also be recorded and posted on our event page either tomorrow or on Monday. But we do really thank you for joining us live. With that, I'll introduce Mr. Mike Moore.
Michelle, thank you very much. And again, we're here with another Fireside Chat. I try to make sure we have some good, pertinent, relevant, and interesting insights from foremost experts in their field. And today I've got the honor of having David Lohman and Timothy Jacobs, both partners at the law firm of Hunt and Andrews and Kurth, and both are the foremost experts in this particular case, 45Q and related tax credits that we're seeing a lot of uptake on now with all the work that's come out of the IRA bill and bills previous to that. Very hot and active space right now. A few questions left to get answered, and a huge market space getting ready to unfold and open up around us. Really enough about me, and what I'm going to do is I'm actually just going to jump right into it because there's a lot here I'd like to learn as well. With that, I'm going to turn this over to both David and Tim right now, and we'll run it till they're done, and then we're going to open up for a Q&A session. We're scheduled for an hour, but to be warned, if the Q&A is rich enough, we'll let it run for up to an hour and a half. So off to the races. And gentlemen, thank you guys both very, very much for taking time out of your incredibly busy schedules to do this today.
Excellent. Thank you, Mike and Michelle. This is Tim Jacobs from Hunt and Andrews Kurth, and let's get moving forward. So we're almost a year out from the passage of the Inflation Reduction Act. Was signed on August 16th of 2022, and we're talking about originally $270 billion in credits that were estimated. Now under the most recent revised projections, we're over 660 billion. It's likely it's much higher than that in terms of the tax credits that were provided in this game-changing legislation. Among other things, what we see is the IRA provided some very new credits, like the clean hydrogen credit, but also provided what we're talking about here, which is new methods of tax credit monetization. For all you familiar with the past, the 1603 grant program, the direct pay is more like grants, but for the first time ever, now we have this transfer mechanism where you can actually sell tax credits for the first time under the federal income tax code. A plethora of credits that are provided under this Inflation Reduction Act. Some are familiar, some are new, but you can see everything from nuclear to extension of the carbon capture credit to advanced manufacturing credits, enhancements under the 48 Cap C investment tax credits, and where we're moving to starting in 2025, these technology neutral concepts, which are going to be based on zero emissions or life cycle greenhouse gas emissions. So a variety of tax credits provided under the Inflation Reduction Act. many different guidance projects relating to those. We also see what I would say are new tax credit features and bonus credits, adders. Last week we saw come out the Davis-Bacon regulations from the Department of Labor. Those have a high level of relevance to everything that's under the Inflation Reduction Act in terms of tax credits, because every one of the credits that we have dealt with, or we're generally dealing with, except for perhaps the manufacturing credits, have a 5% multiplier to the base credit that is contingent on satisfying these labor rules. We also have domestic content rules, energy community bonus, and then we have these provisions that some of the carbon capture folks will be familiar with, which are life cycle greenhouse gas emission rates measurements. You can actually get up to about 50%, 60% even under an ITC now under these enhancements that the IRA added. Carbon capture credit, it was extended. Now we're out through 2032. Why are we talking about this 45Q credit here? Because it's one of the credits that would be eligible for the direct pay. It's one of the few credits. There are only 3 of them. The other credit, and you can see at the bottom here of our slide, that enhanced oil recovery upwards of $60 per metric ton under this new legislation. Sequestration upwards of $85 per metric ton, other enhancements made to the 45Q credit, and then the new hydrogen credit, very rich credit, 10-year credit period, production period, extended out through 2033, $3 per metric ton of clean hydrogen is $3 per metric ton or per kilogram. If you satisfy the labor requirements, very rich credit. So 45B, 45Q, hydrogen, and carbon sequestration, those are the direct pay credits. Subject today, the tax credit monetization rules. Again, there are 3 ways effectively that you can monetize tax credits. There is the traditional way, which we've been living under for as long as I remember and as long as I've been practicing, which is the traditional tax equity structure, partnership transactions, subject to IRS rules. But now you have the direct payment or elective payment rules, which are in essence a grant that is administered through the tax code. It functions like a grant or a refundable tax credit. And then you have now the transferability provisions under 6418 of the code, where you can now sell the tax credits. You can sell those for cash to a transferee taxpayer, and the transferee steps into the shoes of the transferor.
Yeah. So, Tim, we're going to get into it in a minute, but this group, which is very much focused on carbon capture related issues and decarbonization, 45Q, as well as the hydrogen credit, which may involve carbon capture, and both of those will have 5 years for direct pay. And then the remaining credit period of 7 years, it's 12-year tax credit period for 45Q. It's a 10-year credit for 45V hydrogen. You would most likely be looking at direct pay for the first 5 years, and then a transfer of the tax credits for the second remaining period of either 7 years or 5 years.
Correct. Correct. And so recently, in June of this year, Treasury and the IRS issued very detailed regulations in the form of notice of proposed rulemaking. These are the proposed regs. What we would expect is we'll see final regs in or about late 2024 or 2025. I think the turnaround time is 18 months in general, but sometimes longer than that. But we saw both very detailed 108 pages of both preamble and actual proposed rulemaking regulations being issued in June 14th. And then there was comment period. Many comments were filed by stakeholders in the industry, and public hearings were actually held this week. Both David and myself spoke at those public hearings on both the direct pay issue and on the transferability issues. We expect that there will be additional IRS guidance. It probably will relate to some of the procedural issues. That guidance may come out in the form of sub-regulatory guidance before the end of this year, or as the direct pay and transferability provisions are put into effect. So let's turn to direct pay for at this point. One of the interesting pieces about direct pay is now, for the first time, tax exempt organizations, and not just tax exempt organizations, but governmental entities. And governmental entities would include, for example, the public utility districts, PUDs, school districts are included, agencies and instrumentalities were covered under the proposed regulations. All of those entities, Tennessee Valley Authority, so for example, hydropower, is publicly owned by government, quasi-governmental entities or federal instrumentalities. Those entities now can receive the direct payment, and in fact, they are the primary recipients of the direct pay. All the rules that typically would apply to the tax code have been turned off with respect to those tax exempt organizations. We always look at the tax exempt property rules and the ITC reduction rules. At this point in time, if a tax exempt or governmental entity has direct ownership of a facility, they could qualify for the direct payment and receive effectively what is in the form of a grant through the tax code. One of the issues that everyone has been struggling with is, how do we create a public-private arrangement or partnerships? And the proposed regulations that came out in June largely shot down or cut off a lot of the proposed structures, such as chaining transfer of the credits with a direct payment election by a tax exempt, or a actual partnership between a tax exempt entity and a taxable entity, whereby the parties share in investments. IRS and Treasury said that's not acceptable, but the one area that they did provide some flexibility with was with respect to undivided interest, i.e. tenancies in common. Question there is whether that works under state law. If it does work under state law, there may be some possibilities of structuring around undivided interest to capture and monetize tax credits through direct pay with tax exempts. Taxpayers, as we said before, there are 3 credits that are eligible for direct pay for taxpayers, not tax exempts. That is the 45B clean hydrogen production credit, the 45Q carbon dioxide sequestration credit, and then the advanced manufacturing credit, which is solar components, wind components, etc., under 45X. As David said earlier, the reading of the law and the way the proposed regulations have laid it out is that there's one 5-year period of direct pay, and then as he explained, typically in the context of a 45Q carbon sequestration credit or a clean hydrogen credit, the expectation is you would elect the 5-year direct pay first 5 years, and then for the second 5 years, you will be either in a tax equity or a transfer scenario, likely a transfer scenario. Some of the questions that are outstanding right now that we're dealing with and thinking about, and as we go through this presentation, I think the audience would be helpful to think through, is the timing of the direct payment. Are you going to get to direct pay amount? In some cases, these are millions. In some cases, they may be billions of dollars, for example, with the advanced manufacturing credit. Are you going to receive the direct pay timely from the IRS? And I think a lot of people with experience getting refunds of that nature already know that the IRS even in a typical scenario are slow in getting refunds out. But in the context of direct pay, as we'll see later in the presentation, there is a pre-filing registration process and an IRS review process. And the question mark is, will direct payment be made on any timely basis? Because the proposed regulations as they exist right now do not require or do not state any timing for the IRS to make these payments. That runs into issues such as, how do you finance that bridge? How do you take care of the gap if you've constructed a facility, you're relying on direct pay, et cetera? How do you finance that gap? Discount on the tax, David?
So one point about that, Tim, is what we're seeing right now in sort of with respect to project finance related to carbon capture is developers seeking project finance that will be secured by the direct pay of the tax credits. So a lender may enter into a transaction with the developer of carbon capture that says, we will loan you this money and you will pay us back out of the direct payment for the tax credit you receive from the government. And that structure is being considered by various investment banks, developers, and so forth. One of the issues there is the one you point out with respect to the timing of the direct payment. Banks generally want to know exactly when they're going to get repaid. And this is a situation where we don't know exactly when the government is going to send that check to the taxpayer. So that's one of the issues that folks are trying to deal with in the financing of carbon capture right now, where they're going to be relying on direct pay.
Right. Normally, the second question here was a discount on tax credit transfers. And David, I think, I don't know what's out in the marketplace right now, but we've heard numbers in the 80%, 90% range on credits. And I think the third issue we have here is the volume of the tax credits you mentioned earlier. We're talking about $660 billion plus in tax credits that are going to be out in the marketplace at some point in time. Is there enough tax liability within the United States to actually absorb the credits as they are being generated, especially some of these rich credits? And, is that going to drive down the discount or create a larger discount on the tax credit transfers when in the context of transferability?
Well, that's right, Tim. So right now we're seeing 95 cents, 90 cents, maybe 85 cents. I mean, that's a matter for negotiation between parties. But if some of these very large tax credits for 45Q, 45B, of course, a lot of these projects haven't gone online yet, but what happens when they start coming off of the 5-year direct pay and these very large volumes of tax credits are now flooding the market along with the wind and the solar and all of the sort of regular renewable, is that discount going to go from 90 cents down to a much lower amount just based on supply and demand? Something for people to think about and consider going forward.
So looking at some of the general rules, there's an applicable entity, which we said it earlier, that's the tax exempt entities, the governmental entities, and you have an electing taxpayer for the 3 credits we mentioned, including 45Q, carbon sequestration, and clean hydrogen. And what, how the tax code works and how the regulations work is that the tax credit is converted essentially to a payment. It's treated as a payment against federal income tax. It's not actually a grant. So it is more like a refundable tax credit in that sense. And it is the entirety of the tax credit becomes a payment against federal income tax. Now, the devil's in the details, because how that payment actually gets reported in the tax return, how it actually gets administered, and how it gets refunded to the taxpayer, not yet clear. And that was the subject of some of our comments and some of the comments of other stakeholders out there. There are special rules for partnerships and S corporations. Generally, the elections that get made at the partnership level. for direct pay. And then you would have tax exempt income that would have to be allocated out to the partners, consistent with how generally the credits would be allocated if they had been utilized as credits rather than electing direct pay. Generally you have to make the election before the due date of the tax return, and it's the original tax return. It's not the amended tax return or any later tax return. So generally it would either be earlier in the year in April or October-ish for making the election, the direct pay election. And then the payment is then treated, it's deemed to have been made as of that later date with the extensions for the tax return. Doesn't mean it's necessarily going to be made on that date. It's made on the electing taxpayers' annual tax return, as I said, original tax return. There are no amended returns. There's nothing that's of the nature of 9100 relief. And once it's made, it's irrevocable. So for that 5-year period, you're stuck with direct pay unless you have one election to revoke in the case of the 3 credits that are for taxpayers. But you can't go back. You can't switch between direct pay transferability after revoking and then going back to direct pay. It applies to the entire credit. You can't split the credits, i.e. do part direct payment, part transfer, and then it would apply both to the applicable credit and then also the base credit and then the bonus credits that we mentioned earlier. So you can get direct pay on the full amount of the available credits for the resource or the technology. Pre-filing registration process. So this is a feature that is both apparent for direct pay and transferability. And so before you file your tax return, you have to go through this process. The IRS is setting up an electronic portal. They have already started some webinars to explain to stakeholders how to use the portal. It is similar in some respects, I would say, to the old Section 1603 electronic submissions, and certain information, as we'll see, is required to be submitted. But what the IRS is after and what the Treasury Department is after and what they've announced in the proposed regulations is they are very concerned with the notion of whether there are fraudulent transactions or fraudulent claims, etc. The statute provides that as a condition of and prior to any amount being treated as a payment, and again, as a condition of and prior to any payment being or any amount treated as a payment, the IRS or the Treasury Department may require such information or registrations the Secretary deems necessary for purposes of preventing duplication, fraud, improper payments, or excessive payments under this section. And so these pre-filing registration rules were put in place for that purpose. And if you do not receive a valid registration number by the time you have to file the tax return to make the election, you can't make the election. And so this is an issue that we commented on as to exactly how this process will work and what happens if inevitably the IRS delays issuing registration numbers and you somehow trip up past the original tax return date. So again, to go through the process at this point in time, not clear exactly what the process will involve. You have to provide specific information that the regulations lay out. But there's also a catch-all which says any other information the IRS deems necessary for purposes of preventing duplication, fraud, improper payments, or excessive payments under this section is provided in guidance. And so the IRS may actually request additional information on top of the 9 or 10 items that they've specified, such as the location of the property, the nature of the property, is it solar, is it wind, is it hydrogen, etc. Who's the taxpayer, those types of things. In addition to that information, they have a catch-all category, other information. What that will be, we do not know yet, and we will see how this plays out. The other part of this is the IRS is required to review. The proposed regulations say that they will review the information as provided, And only after that review, will they issue the registration number. In our estimation, this registration process, absent obvious fraud or indications on, we have taxpayers out in that are a party that's submitting information that we know doesn't exist, or that the IRS can verify doesn't exist on the face of what's submitted, different story. But when the IRS reviews this process, it really should be ministerial. We do not know yet whether they will go beyond that to asking substantive questions, etc. But you must have that registration number in order to go forward. And you have to do it each year. So in the case of carbon sequestration and clean hydrogen, you have to renew the registration every single tax year during the 10 or 12 year credit period. Here's one of the I guess penalty provisions, or one of the I guess policing provisions that would apply to direct pay, also applies in the context of transferability, which is the notion of an excessive payment. An excessive payment is simply the amount that's allowed under the law as the tax credit, and what you claimed on the tax credit, or it claimed as the tax credit. So if the IRS were ultimately determined that you were not entitled to the full amount of the credit for various reasons, and the regulations, proposed regulations lay out a number of them, which is inflated basis. That's an issue that we have been dealing with in audit litigation now for almost 10 years or more, in the context of the ITC, the investment tax credit. But there are other issues as well, such as errors in calculating the credit, that are less benign, but seemingly anything that would cause the credit to be that allowed to be less than what you claimed would trigger potentially an excessive payment amount and penalty. The penalty is 20%. It is subject to a reasonable cause exception. There's not a lot of detail provided in the proposed regulations regarding what is reasonable cause in the context of direct pay. We would assume that the same rules that apply in the context of Section 6664 and normal IRS taxpayer practice and administration would apply also in the context of direct pay. Did you do the diligence? Did you look at the credit? Did you rely on a advisor? Those types of things, those types of facts and circumstances. Another thing that the proposed regs did was confirm what the statute essentially says, which is that the amount of the excessive payment, which is the delta between what is allowed and what you claim, plus the penalty, that is applied in the year of determination. It's not applied backwards to the taxable year in which you claim the credit. That is different than how other tax credits, tax credits normally work or have worked up to this point in time. This is a new feature of the direct pay and transferability, which is it's the year of the determination. Whose determination? Well, it's the determination by, we would assume, the IRS, not necessarily clear. What does that determination involve? Again, not necessarily clear. Do you have the ability to appeal that determination? Again, not necessarily clear. Those were subjects that we addressed during our comments to Treasury and IRS, and we hope will be clarified in final regulations and also in practice so that the taxpayers get clarity.
Tim, I would say with respect to the excessive payment penalty, something that's certainly relevant to ITC, where the government has seen a lot of inflation in the basis of qualified assets for the investment tax credit. When I've considered the 45Q carbon capture credit, it seems less opportunity for inflating the value of the tax credit. You've got an MRV plan that you're reporting to the EPA, the amount that's being sequestered, et cetera. And so those are known numbers. They're not based on value, such as the ITC. Probably a lot less opportunity for application of the penalty with respect to the 45Q tax credit compared to some of the other renewable tax credits out there.
Right. No, I agree with that. Well, transferability, this is the other side of the equation, which is for all, other than 45Q and 45B, or in the later years after your 5-year period, but for all the other tax credits such as tech neutral PTCs and ITCs, transferability is likely to be the vehicle that's used for monetization in the future. What is required under the statute is that you have an actual sale. We've litigated cases, have been involved in audits where the IRS has looked at partnerships and said you cannot sell tax credits. After the IRA, the tax code now encourages you to sell tax credits under the transferability rules. And indeed, I believe these rules, the congressional intent was to replace the traditional tax equity partnership structure with transferability. It is a direct transfer of the credit from a transferor taxpayer who is eligible to claim that credit, transferring that credit to a transferee for cash, has to be paid in cash. And so US dollars, obviously there are many forms of immediately available funds that are can be used, but those are the essential requirements. The cash that's coming into the transfer taxpayer, that is not taxable income. The statute says that. And on the other side, the amount that is paid by the transferee, that is not deductible by the transferee. One of the big issues that we have and would be relevant, I believe, and I'll ask David this, in the context of 45Q and potentially in 45B, is our traditional structures have involved an advance payment in the front part of a transaction. For example, wind, Rev Proc 2007-65 essentially requires an upfront payment of 75% of the estimated and projected credits. And so what you have is, under the proposed regulations, they have allowed, or what they refer to as an advance commitment. But what's not necessarily clear is whether you can do an advance payment. We had submitted comments that suggested that, consistent with the law as it exists and the guidance that the IRS has put out with respect to upfront advance payments, that you should be able to do that, i.e. buy, the transferee can buy the full allotment over the 10 or 12-year tax credit spread, and do that up front so that the transferor or developer, sponsor, etc., can remove some of the construction debt, etc., and use that cash for other projects.
Yeah, and Tim, for a 45Q, the revenue procedure is 2020-12, which is a little different from the wind revenue procedure. 50% fixed payment for 45Q does not necessarily have to be paid up front. At least 20% has to be paid up front, but some transactions would consider paying 50% up front. And so, under that tax equity type structure, could you receive, say, up to 50% of the projected tax credit before those tax credits have actually been generated? And we've said they should allow that to allow consistency with traditional tax equity structures, and to get that cash to the developer to discharge its construction debt, to discharge its equity, and then reinvest that in further development and development projects.
Transfer election gets made on a facility by facility basis. And so, this is one of the issues that we have seen is under the provisions. When you deal with, for example, a wind turbine, the IRS considers a wind turbine to be a qualified facility. Each wind turbine and its supporting foundation and tower, each wind turbine, and there could be 100 or more wind turbines in a wind farm. Each one of those would be considered a qualified facility. in the context of a 45Q carbon capture credit, it's actually the single process train that's defined in the regulations that's considered to be the eligible property or the applicable credit property for purposes of transferability and direct pay. And in the ITC property, you actually can elect up to the full energy project. What they did not do in these proposed regs was they did not pull back for things like the wind turbine. They did not define and allow a project election that would encompass, multiple wind turbines. Some folks have called it batching, others have called it, single project election. But it does create a big issue when you get into the registration process, because you could have hundreds of applications going in to this electronic portal, and you would have to renew that every year. It's one of the items we've asked for clarification on, and it's one that, frankly, we think is no brainer and a miss that the Treasury did with respect to certain things like wind turbines.
Well, not only wind turbines, but more specifically to 45Q, the industry asked for and received in the final regulations basically a single project rule, because we were looking at having to satisfy the minimum carbon capture requirements, the benchmark, okay, how much carbon capture. And so there was an aggregation rule based on single project where we could aggregate various carbon capture projects, treat them as a single project for purposes of meeting the minimum threshold requirements under 45Q. And so that constitutes for 45Q the equivalent of a single project, and they should extend the rule for registration to what we designate as a project, because otherwise, single process trains alone may not constitute a qualified facility, or, because they might not capture the requisite amount of carbon. So I think we'll see them make some change here. And I think they understood that when we discussed it in the hearing.
Right. Discussed earlier, there's this notion of a chain transfer, I think is described in the proposed regulations, and others have described it. There's only one transfer that is permitted under the rules. You cannot make a second transfer. So I'm a transferor, I transfer credit to taxpayer one. Taxpayer one cannot then go out and transfer the tax credit to taxpayer two. So there cannot be multiple sales. I know in some state tax credit programs, there are actually chain transfers where you can sell the state tax credits, multiple times, and inclusive of as low as, any tier down you can go. That is not permitted under these transferability rules. Only one transfer is permitted, and you cannot do, as I said, transfer the credit over to another party who would then claim the direct pay. That is not permitted. You either have to choose direct pay or transferability.
Tim, one point there that we sort of neglected to talk about specific to Section 45Q is that Section 45Q was one of the first sections to provide for transfer of the tax credit. It could be the tax credit, which is attributable to the owner of the carbon capture equipment, could make an election to transfer the tax credit to the party performing the sequestration or using the carbon for EOR, and you can transfer that tax credit. One of the things that the proposed regulations on direct pay said is if you transfer the tax credit under the 45Q provision for transfer, the recipient of the tax credit, that is the sequestering party, cannot then claim direct pay.
Right.
Direct pay can only be claimed by the owner of the carbon capture equipment. So in the comments that were submitted in the last week or two, there was an argument made, wait a minute, the transfer of the tax credit for purposes of 45Q is very different from selling your tax credit, because what you're talking about is not transfer of the tax credit to an unrelated, third party out there. You're transferring it to someone that is involved in the carbon capture sequestration chain. They are involved, and you ought to be able, as the transferee, if you're the sequestering party and you receive that tax credit, you ought to be able to claim direct pay. We'll see whether final regs change the position on that, but I just wanted to point that out.
So you can transfer a portion of the credits under these rules and retain the rest. So there are a different mechanism perhaps than the direct pay, which is the entire amount is treated as a payment. Under the transferability rules, I'm a taxpayer, I have tax appetite for X amount, and I decide, well, I can't not use the rest of the remaining amount. I'm going to transfer those credits. So you can use some of the credits on your as a transferor, and then you can transfer the remaining credits. You can transfer to multiple transferees. These were issues that were not apparent from the statute, perhaps in explicit terms, but the proposed regulations from Treasury did make it clear that you can transfer a portion of the credits and also transfer to multiple transferees. What you can't do is you cannot split the credits, and this is one of the controversial items that a number of stakeholders have talked about. There are different risk profiles with those tax credit features we talked about earlier. One of the biggest issues out there right now is the domestic content bonus credit. Domestic content bonus credit doesn't apply necessarily to 45Q and 45V, but it does apply in the context of 45 and 48. And that domestic content bonus credit does have a risk profile with it that's different than the base credit. As well, the prevailing wage and labor requirements, they've actually, Treasury and IRS have actually, even though those are not bonus credits, those are actually an additional or increased in the tax credit. They've treated that amount as essentially part of one credit. So what you have to do is you would have to transfer under the proposed regulations. You're only allowed to transfer what is a proportionate share of the base and the bonus. You cannot separately allocate, for example, or transfer the base, which has a lower risk profile, and then transfer or retain the bonus credit portion. They will basically do what one commentator the other day referred to as a vertical slice through both the base and the bonus. That's an issue that we hope gets resolved in the final regulations and will allow transference of different risk profiles in the marketplace.
Of course, Tim, that's not particularly relevant to 45Q or 45V, which are not
Right.
eligible for the domestic content bonus, the energy community bonus credit, which are applicable to sort of the general renewable energy credits.
Correct. Partnerships can likewise can be transferors and they can be transferees. Same issue with tax exempt income. Basically, the cash consideration is treated as tax exempt income, and it's going to be allocated to the partners consistent with how the credit would have normally been allocated if the credit had been claimed by the partnership or retained. Recapture, less relevant to the provisions that we're dealing with in 45Q and 45V, but the recapture rules are very controversial under the transferability rules. Basically, the recapture liability sits with the transferee. The The one exception to that is with respect to partnerships, where a partner in a partnership disposes of their interest, that partner would be subject to recapture, whereas the transferee would not be under those circumstances. That is the one exception that the proposed regulations had put in place differently, but otherwise it's the transferee taxpayer that would have to have the responsibility for any recapture amount with respect to an investment tax credit. Also, in the context of 45Q, however, it would be the transferee taxpayer under the proposed regulations that is responsible for any recapture under 45Q F4 in the Treasury Regulation -5, where the carbon oxide ceases to be disposed of or used as a tertiary injectant. So that would be relevant in the context here. It's a transferee taxpayer that would have that responsibility. Procedures, as I mentioned before, very similar procedures on the pre-filing registration process. Likewise, the IRS is going to require a transferee election statement, certain information in that process to be provided. That process would also include other information as the IRS deems necessary. And then the transferor must actually state that they have provided the transferee with required minimum documentation. That is an interesting provision in the proposed regulations, but basically it's information that would validate the existence of the eligible credit property and substantiating that the taxpayer satisfied all the requirements. So that's an issue where the transferee is going to, as we'll see, is going to be held responsible. Essentially, the transferor is going to have to say they were provided that information, that minimum documentation to substantiate. But when you get to the excessive payment or excessive credit transfers, again, the same excessive credit transfer provision plus the penalty applies, very similar to what we talked about with direct pay. But reasonable cause in this circumstance would be based on the transferee taxpayer's efforts to determine that the amount of the specified credit portion transferred to the eligible taxpayer to the transferee taxpayer was not excessive. And so that would involve review of those records that come from the transferor, that minimum documentation and other information. And again, it's the year of determination when the excessive payment or the excessive credit transfer amount would be applied, and any penalty would be applied to the transferee. Again, we do not have information regarding the audit procedures. Not really clear what the IRS review process will involve in the pre-filing registration process stage. And also, when you look at the IRS has set up a web page on its website that has frequently asked questions. The frequently asked questions talk about the notion of an IRS audit after the pre-filing registration process has occurred. Again, we don't know what the audit procedures are. Importantly, we do not know if subtitle F applies. It's not clear at this point whether typical deficiency rules would apply, whether you have a right to go to IRS appeals, and importantly, in the context of the direct payment provisions, whether underpayment interest or overpayment interest would apply, refund interest would apply to a delay in the payment of that direct payment. So those are questions that we hope will be answered in the final regulations. We expect that they will be either in those final regulations or in sub-regulatory guidance as the process goes along. As a general matter, that concludes our main presentation, and I think we have some questions that we can handle for the balance of our time, unless David has something else.
Sure. I'll tell you what, Tim and David, my head is very full of new information. Now I see why your role is so critical in sorting through these things. And I am sure that your time is very aggressively sought right now. David, just to check with you, is there anything else you'd add before we go to some of the Q&A that's out there?
No, let's go to Q&A, Mike. We're ready for some questions here.
Got it. All right. Well, I got one here. In your view, how did Treasury and IRS come out in its proposed regulations? And perhaps more importantly, how has the energy industry responded?
Well, Mike, I think they did a terrific job, to be honest with you.
Yeah.
These are hundreds of pages for each of these sets of proposed regulations. I told them at the hearing yesterday, I said, I want to tell you something that you don't hear enough. Thank you. Great job. Congratulations. You know, you really did a good job with this one. The way the industry has been responding is there is a tremendous amount of interest in transferability of tax credits. And that is something that, you know, we've been working on term sheets and already working on transfer deals on behalf of clients. Those have been in the works, waiting for the guidance to be issued. And those are ready to proceed. As I mentioned earlier, with respect to the direct pay, again, folks are looking, particularly in the carbon capture area, 45Q, of developing projects, and we're representing a number of taxpayers down in Texas and some other areas that are looking at carbon capture and looking to use the direct pay as the security for, you know, because carbon capture doesn't have a lot of economic benefit often other than the tax credit. So how do they get the cash to develop these projects, which might otherwise be uneconomic or are uneconomic? It's the tax credit. And so the availability of direct pay is a key to getting these carbon capture projects done and securing financing for those projects. So everything is moving ahead, I think, just as it should.
Great. Got a question from the audience, Richard Stavros, and he's as a refresher, when you consider the delays in interconnecting, sometimes 5 years, when can the tax credits be used? Is it when the project starts or when it starts producing the energy, for example?
Well, it depends on which tax credit we're talking about, because the rule for direct pay, and if we're talking 5 years, then I'm assuming that the question is focused on direct pay. It differs for 45Q and 45V. For 45Q, it must be a carbon capture facility placed in service after the end of last year, and the 5 years starts in the year the project is placed in service. Placed in service is well understood in the tax world. That's a term that has been around for, you know, ever since the tax code, just about. And it means when you are up and commercially operating the first year. For hydrogen, they are allowing you, if you had an existing hydrogen facility placed in service, it would be this year. So you could start claiming it in 2023, and you'd have 4 years after 2023. Otherwise, it's the year it's placed in service.
Thank you. This one from Susan Fancy. Do you think there is any chance that 45Q payments will be upped for the carbon capture utilization? Is that movement to get that to be at equality to CCUS, to be at least on par with CCS in the future?
Let me see. I'm not sure. Tim, did you understand that question?
Yeah, I think I did. I think the answer is given where things are at in on Capitol Hill, I would not expect that there's going to be any legislation in the near future that's going to be increasing any credit amounts under the IRA, even under carbon sequestration. I think when we went through the budget process here most recently, you know, even the Republican proposals had protected carbon sequestration, but it's just quite another thing to perhaps increase credits or such and so forth. I just don't see any legislation in the near term getting through this Congress that has to deal with the tax credits. And I would say that conversely, I don't see, I think one of the other questions or thought processes we had was, or we hear a lot is there a possibility that Congress, if presidency changes and Congress changes, whether there's a clawback of the credits? One feature that everyone's familiar with from direct pay or from the Section 1603 days was sequestration. Well, there is a provision in the direct pay that was anticipating that might occur, and they actually the direct pay is actually grossed up in order to eliminate budget sequestration. So we do not have to worry about that. And I think a full callback or a partial callback is, at this point, even if there is a change in administrations, et cetera, I'm not seeing that as a major possibility given where these credits are.
Right. Well, it's the impact is spread across both parties pretty deeply, that you'd need to be hard pressed to get a majority from either side to try to change something.
Yes.
Question. Go ahead.
No, go ahead, Mike.
Question for Maurizio Ponzetto. Sorry if I bastarded that up a little bit. Is Buy America a mandatory condition? In particular, we produce power supplies that feed the technology to produce green H2, hydrogen 2. Is there any chapter where to investigate the product included in the IRA?
So, well, Tim, you want to go?
Yeah, the only provisions that have a domestic content requirement are Section 45, your traditional production tax credit provisions, and what will be the future tech neutral 45Y, which is the counterpart or the extension of the production tax credit. Then you have the 48 investment tax credit, future 48 Cap E. Then you have, as I mentioned, or was in one of the slides, tax exempt organizations or entities. They have to meet domestic content requirements with respect, for example, like hydropower, to get direct pay. They actually have a domestic content requirement that applies to direct pay. Taxpayers don't have that with the three credits that they have. And in the fourth place where domestic content is relevant is actually in the investment tax credit, the 48 Cap C. It is not a mandatory requirement, but it is actually one of the factors that the Department of Energy is using in evaluating projects for eligibility for the advanced qualifying advanced energy projects.
Yeah, so to sort of cut to the point there with respect specifically to hydrogen and hydrogen production, there is no domestic content Buy America requirement for a taxpayer building a hydrogen production facility. Over on the hydrogen hub part, not the 45V hydrogen production,
Right.
there may be requirements that are not in the IRA because the funding for the hubs is coming out of the Bipartisan Infrastructure Act, which may have certain Buy America provisions. We're not expert in that. We're the tax guys, but you might have to look at that over on the hydrogen hub side, but not on the hydrogen tax credit side.
Right. I've noticed that over at there was some waivers were issued by DOT on some highway projects. I just read today that over at FTC, I think it was, there's been some waivers on the American content on broadband gear, because it's to get it deployed and out now is next to impossible without having to do the American made requirement attached to it. So I suspect if that became too onerous anyway, there'd be some latitude. One last question. Go ahead.
Yeah, there is. On the direct pay for public, for governmental entities, tax exempts on receiving direct pay and having to comply with Buy America to receive that, there are waiver provisions in the tax code for those types of taxpayers
Right.
if you cannot buy the product in the United States. But with respect to taxable entities, there is no requirement.
Got it. All right. Very good insights on that. Another question from Flavio da Cruz. Are there any requirements from IRS in regards to how developers measure and verify the amount of carbon captured by a project?
Yes, absolutely. That is a key provision in section 45Q. And what they require is that you go to the EPA or the relevant authority in the state where the state has primacy for determining the permitting requirements, and that you report according to subpart RR of the regulations of the environmental regulations, which require an MRV plan, which is monitoring, review, and verification. So yes, you must report pursuant to those environmental requirements that require you to measure and verify everything very carefully.
Right. And those have been there for some time, I believe, on the 45Q part.
Yes.
A quick question, and then we're right up on our time at this point. If you're a tribal entity, are there any exemptions or opportunities for tribal entities, specifically as tribal?
Yes,
Okay.
under the direct pay provisions, tribal entities would be eligible for the direct payment for the specified credits.
So tribal governments or entities are treated as a tax exempt, the same as a government entity or a tax exempt organization. So tribes can just get direct payment for the entire tax credit period.
Got it. That's good to know too. And I'm going to give you one last, but I guess we'll wrap it up. Otherwise, I've got a whole lot of other questions here that I could run by it, but we'll let people reach out to you direct. When do you think the guidance on the hydrogen credits will be issued?
It was due last week. Treasury was unable to get it issued last week. There are a lot of technical issues for hydrogen.
Right.
There are the three pillars that are being debated. There are, measurement issues. There are issues about, how you measure it over the course of the year, displacement, additionality, so forth and so on. The industry was in support generally of the government not rushing that guidance out last week. What we hear is by the end of October, we should have that guidance, but some people will also tell you that could slip and it may be just before the end of the year, but we're still a couple of months away from anything coming out on hydrogen. As far as this is not publicly announced, Mike, this is we Washington lobbyists, what we're hearing.
Sure, fully understand, appreciate how that works. And anybody up here on the Hill also does as well. So I guess what I'm gonna do is I'm gonna wrap us up. There's like I said, a number of questions. You can reach out to our gentleman, through us, to find them direct. Contact information's on our website. The presentation and the video today is going to be available through the USCA website with no restrictions to the access. And with that, I want to say thank you, gentlemen, a lot for taking the time you took to be here today, knowing how busy it is. And with that, I'm going to turn this over to Michelle and set us on our way.
Yeah, once again, everyone, thank you very much. Mike, I think you went over everything that I was going to. If y'all have any other questions, feel free to send them to David or Tim, or myself, littlefield@usca.org, and I'll spread out the questions from there. Thank you all for joining us.
Thanks very much.
Thank you all very, very much. Much appreciated.